Good morning, traders. I'm Dan Pavlonis, Senior Market Strategist here at RJO Futures, talking about the currencies. Well, we've seen a lot of volatility over the last week or so with Greece. Greece defaulted on their IMF payment, and so now we're seeing kind of this vote on Sunday to see it's a referendum to see if they want to stay in the eurozone, or maybe stay in the eurozone but off the euro currency and not have to abide by a lot of the eurozone currency rules implied by the eurozone officials. So what that could possibly do is kind of give them an opportunity to default on everything and start over from scratch. But what would be the collateral damage on that? The other side of that is maybe if the referendum is to vote yes to stay within the euro currency and have to get another bailout package or abide by the bailout rules that the IMF and the ECB sets for them. That's another avenue that they can go, but it's still they're embedded in debt, and the austerity measures haven't worked in the last 5 years. I think it's highly unlikely that they're going to last or even do anything beneficial to the Greek economy over the next 5 years. So with that being said, where does that leave the U.S. and the dollar index? So we've seen a lot of turmoil in Greece, and how does that affect the Fed? The Fed raising rates, does it kind of push back rates? I really think that even though the economic data has been somewhat subdued, but bouncing back compared to what it was in the first quarter, I think the Fed will still raise rates this year, because I think what they're trying to do is kind of this confidence multiplier, a study that was produced probably in the early 2000s, and what we've been working off of were the confidence multiplies more confidence. So you see the Fed officials talking up rates before they're actually implementing rates. You see the bond market kind of following suit to that. So if the yields are at like 3-4%, let's just say 3%, if the Fed raises rates to a quarter percent or even 0.5%, it's not really doing that much damage to the economy. And the multiplier is already built in enough confidence to kind of see that was kind of already baked into the markets. Another thing that may do too, and there have been studies written about this, and the Fed has been looking deeply into this, is because lowering rates hasn't spurred the economic growth that they thought that it would. Raising rates a little bit might jumpstart people buying houses and getting out loans, businesses buying or getting loans prior to having to pay even more interest if interest rates keep on going up. So why not lock in the money now at basically 0% interest rate? So we saw a similar situation of this model happen in the ECB before they started quantitative easing. It was kind of this long dragged out media intense situation where Mario Draghi would continuously talk about quantitative easing and kind of have the market already trade ahead of any kind of quantitative easing and already price some of it in. So when it actually happened, it didn't affect the markets to a great extent. So if you have any questions, you want to talk further about this, give me a call. Dan Pavlonis, Senior Market Strategist. Thanks.
Of substantial risk and may not be suitable for all investors.